Welcome back to our intermediate financial accounting class. Over the last few segments, we've been talking about pensions, what they are, why they're important, the different kinds that we can create and use, the journal entries for defined contribution, really simple, to the more involved journal entries and tables and worksheets and calculations and T accounts for a defined benefit plan. And then we finally, in our last segment, started to pull all of that together into some comprehensive examples. And now we want to continue with that example so that we can get a little bit more practice. So last time we did year 3, now we're jumping into year 4 of our ROS 1 example. Let's take a look. So we started with beginning balances of $1 million in our obligation and $800,000 in our assets, and then a debit balance of $135 in our accumulated OCI actuarial gains and losses. You remember we added a prior service cost by renegotiating in year 3. And now we're ready to go on and do our calculations for year 4. So we have new service cost, discount rate, expected rates of return, and a change in actuarial assumptions that come right from our actuary. We also know that we contributed $150 in our pension plan, up a little bit from last year as we've realized that maybe our numbers aren't quite as good as they should be, and we need to get closer to fully funding this pension. And then we have a small actual return, and we paid out some benefits this year to our retirees. With those numbers, we're ready to jump right back into a worksheet. And here's our year 4 worksheet ready for us to put in our information. So from our previous example, we know what these beginning balances would be. They come right from last year's worksheet. So let's go back and take a quick look. So let's see, we have $164 in our prior service costs. We have $152 in our actuarial gains and losses. We have $1346 in our PBO and $905 in our plan asset. So let's get that into our new worksheet, moving from ending balances now to beginning balances. So we start with 164 debit, 152 debit. We have 1346 credit as our obligation, and 905 debit for our assets, which gave us a funded status of 441 once we made our adjustments for the prior service costs. Now, we don't need to do an adjustment for prior service costs up in step 1 this time because I didn't renegotiate anything. There's no change there. So I'm going to just leave that blank and move right in to my normal income adjustments that are step 2. The service cost was provided by the actuary. It was $120 for this year. So we debit service costs for $120 and we credit our projected benefit obligation. Next, we had our interest. So let's see, we take 8% is the discount rate we were given times 1346, and that gives us 108. So again, that increases our expense and it increases our obligation. And I don't have to worry about adding in the prior service cost. It's already been added and incorporated as part of this beginning balance. My expected return this year is 7%, and I have 905 in my account. So I end up with an expected return of 63,000. So that's going to reduce my expense, and I'm going to debit that in my actuarial gain or loss. Remember, I'm taking out of the actuarial gain or loss and using it to reduce pension expense. That's the logic that FASB came up with. So that's step 2. Step 3, we contributed to the plan $150,000. That reduces cash and increases our plan assets. We paid out $125 to our retirees, and our actual return was $60,000. So we've got a debit there and a credit here. Now let me just pause for a second. I've been pulling numbers really quickly, but all of these numbers come from this example right here. So all of this is coming right from here. The only one we haven't accounted for yet is this change in actuarial assumptions, where they've changed their percentages or their methods or their statistics in some way. And in this case, remember, the negative means that we reduce our PBO, we reduce a liability with a debit. So we're going to debit our PBO for 50 and credit actuarial gains and losses. That takes us through steps 1, 2, and 3. Next thing we need to do is step number 4. And for step number 4, we need to have a little bit more room to work. So let's start out with our prior service cost amortization. Remember, the rule is if I have a balance up here in prior service cost, then I'm going to amortize some of it away. But I was wise in the way I did it before. When I first did my table, I did all of the calculations from year 3 all the way to year 11. So I've got the year 4 number. It's right here. I don't need to recalculate it. I don't need to change it unless I've fired some employees, hired some people in, people have changed when they're going to retire. That could change this. But assuming everything stays the same, then I'm going to record, again, rounding it, a $33,000 adjustment. So let's bring this back. 33,000 right from the table that I already created. I have a debit balance up here, so if I'm going to get rid of that, I need a credit. And the flip side of it, if I credit here, then I need to debit in my pension expense. Last piece of this is to get our amortization for our unrecognized gains and losses on accumulated OCI, meaning our corridor smoothing. Now, we may or may not have to do this adjustment. It depends. We need to do the test so we can find out. So let's go ahead. Our beginning balance was $1346 for our PBO and $905 for our plan assets. We multiply those by 10%. I get $135. So my corridor has grown significantly, and 91. So new balance here. Again, this is 0. This is 135. This is negative 135. And our maximum quarter value, just to finish this off, is 135. There we go. And our beginning balance of our accumulated OCI is right here. I'm at 152, so try as I might, I'm still not doing all that great. I'm way up here, 152. Even though I tried to amortize away some of this last year, it actually got worse. It got bigger. And I still need to bring it down. So let's see. Is it greater than the corridor? 152 is greater than the 135. So I take the difference, 152 minus 135, and my difference is going to be 17,000. Last year I was $35,000 over. This year I'm only $17,000 over, even though I increased in value. The change in the corridor width has made it so I have less of an adjustment. So I know I need to make an adjustment. I've got to figure this out. I need the average remaining service life of my active employees. To do that, I go back to this table down here, and I'm going to add up the total remaining service life for all of the remaining years. Well, that's year 4 to year 11 now. So 185 plus 185 plus 165, all the way down to that, the year 10, 30, and year 11, 30. If I add that up, it gives me from here to here is 915. And I'm going to divide that by the number of employees working for me this year, which is 185. So 915 divided by 185, I'm going to round to 2 decimal places, gives me 4.95. And if I take 17 divided by 4.95, I end up with a value of 3,000, rounded. So now I've got my 2 numbers that I need for my worksheet. I need 33,000 for the prior service cost, which I've accounted for, and I need 3,000 for my corridor smoothing. So again, I've got a debit balance up here, so to smooth it away would take a credit, and I'll put a 3 over there as well. One of the things I love about the worksheet is the fact that I've got a debit and credit in every single one of these rows. I know I need them. Matter of fact, the other day I was doing an example and nothing balanced, and it made me really upset, and I took a quick look at my worksheet and I realized I was missing the credit on one of my calculations. So I had a debit in there but no credit. And it was an easy fix. I knew if I had a debit, I had to have a credit, and sure enough, once I put that in there, the whole thing flowed through. So it's nice that we have a shortcut like that when we're doing our calculations. All right, let's add up and get these last 2 rows. So 120 plus 108 minus 63 plus 33 plus 3 gives me 201 as my pension expense amount for my journal entry. Let's see, 33 plus nothing gives me a credit of 33 for prior service costs. 164 minus that credit of 33 131. Again, it's shrinking just like it should be. 63 minus 3 minus 60 minus 50. I get to show an actual credit this time and really drop this value. And if I have 152 debit, credit of 50, I end up with a balance of 102. 150 in cash, no ending balance. I don't worry about this number because it doesn't make any sense. So now we're going to do our PBO and our plan asset. So negative 136 minus 120 minus 108 plus 25 plus 50 gives me a new balance of 1399 credit. 905 plus 105 minus 125 plus 60 gives me 990. And I end up, if I take the difference between those two, not a huge change, but my net pension obligation has dropped a little bit for me. Whew, a lot involved there. We went through it kind of fast. Hopefully that all made sense because it's time for the journal entry, and I am so excited to do that. We're going to just use the numbers that we have right down here, and we'll start, as always, under this new GAAP rule by breaking this 201 into its two pieces. The part that's compensation expense, that'll be the 120, and the remainder, 201 minus 120, or a debit of 81, going into our net pension cost. And then, of course, we have our other values. So let's go ahead and do that. We'll start with our compensation expense. And we're using compensation expense as the account name because that's what FASB uses in its examples in GAAP. But the reality is you'd use whatever your company calls compensation expense. Wages expense, salaries expense, executive salaries. If this is a pension for our line workers producing our product, then it would actually become part of our inventory and then later become part of cost of goods sold, just like all the other wages that we pay to our line workers that produce our goods. Let's see, that was 120. The rest of the 201 goes into net pension cost, and that was 81. And then we had accumulated OCI prior service cost, and that had a credit of 33. And then we had our accumulated OCI actuarial gain and loss. That was a credit of 50. And we had a credit to cash of 150. So now I'm going to do my calculation. I'll take the 120 plus the 81 minus the 33 minus the 50 minus the 150. I end up with a negative number, meaning my credits are bigger. So I need a debit to make this balance. So I'm going to debit net pension obligation by 32 to make that balance. And this will be my adjusting entry for pensions. And again, I'm not done until I've checked it, so we'll make our T account net pension obligation. We started with the credit of 441. Now we've added a debit of 32, so I have an ending balance of 409 as my credit. If I check that with my balance down at the bottom, sure enough, a credit of 409, that's exactly what I wanted. Now that we've done a couple of full examples, I'm going to stop here, but I don't want you to stop here. If you remember, we have 2 more years worth of data. We've got year 5 and year 6, and I want you to take a look at those numbers and make sure that you're comfortable with them and you get to the right amounts. So take a few minutes, do the journal entries. We have one last segment on pensions that's just going to briefly recap what you'll have worked on doing these last couple of years. We'll see you then.